take that risk. You want to take the risk of flipping the dice because those high returns are going to come up often enough to really make it worth doing. Even people who are, say, into that 50 and 60 age bracket often may have a lot more time than they think. It's true that as you begin to get toward retirement, it makes sense for your time horizon to be a little shorter, to shift away from stocks and shift toward bonds. But if you're 50 years old, you may still have a life expectancy of 30 or 40 years. That's a long time for compound interest to be accumulating. Why not just pick the stock that has the highest rate of return? Why mess around with all this compound interest stuff? Well, the problem, of course, is nobody knows what stock this is. If I knew what stock would pay the highest rate of return, I wouldn't tell you. I would be playing with my children on a beach somewhere and not giving these lectures. In fact, there's good reason to believe that no one knows which stocks are going to pay the highest rate of return. After all, if people did know, they would buy those stocks and push up the price of those stocks to the point where they no longer were as good a deal. One implication of this insight is what's called the random walk theory of stock prices. In general, the notion of the random walk theory is that the price of a stock is going to be determined by the future profits the company earns. And so it's an estimate of that. The current stock price of a company incorporates all the information that is available about future profits. And that's already part of the stock price. So what makes a stock price go up is new information. And new information is by its nature unpredictable. Since you can't predict the new information, the movement of a stock price will be an unpredictable random walk as well. In effect, the problem of buying stocks is you want a stock that everyone else thinks it'll do poorly, but in the future, everybody's going to change their minds and think it does really well. Well, trying to find that is nearly impossible. There's a lot of controversy on this subject, but maybe a sophisticated professional investor who's working 60 or 80 hours a week can pick those kinds of stocks. But if you're sitting at home looking at the Wall Street Journal, which was written yesterday, which has news that happened the day before that, people in the know knew that information weeks ago. You're not going to outguess the market based on that kind of information. And if you start trying to buy and sell and buy and sell and buy and sell, and you have to pay a little bit every time you do that, you can end up losing money overall even when the stock market is going up. In fact, Forbes, the big financial magazine, once did a dartboard fund. The dartboard fund was literally take darts, throw them across the room at the newspaper, and buy whatever stock gets hit by the dart. And then they compared the dartboard fund to what professional investors were doing. And yeah, in any given year, some investors do better, but year in and year out, some investors do better and some do worse. As they say, past performance is no guarantee of future performance. All personal investment advice is ultimately based on one starting point. You need to start saving some money. You need to put some money aside sooner in your life rather than later. Too many people just don't put enough money aside. And then they get to be 55 or 60 and suddenly they think, well, what am I going to retire on? There are always a million reasons not to save when you're in your 20s, and in your 30s, and in your 40s, and in your 50s. But if you don't steadily put money aside, there's no clever strategy you can deploy at age 65 to suddenly become rich.